Wall Street leaders are now openly outlining the exact type of financial backbone that XRP was originally engineered to deliver. So why is almost no one highlighting this? Franklin Templeton recently introduced the idea of what they call a universal liquidity layer. They described an environment where stablecoins, tokenized bank deposits, government bonds, and cash equivalents can flow instantly between wallets, blockchains, and platforms at any time of day. What immediately stood out is that this framework isn't new. It mirrors the core purpose XRP was created to serve from the very beginning. And the timing of these remarks feels deliberate, not random. Let's break down what's unfolding. When a major asset manager like Franklin Templeton begins speaking in precise technical terms about cross-chain liquidity and universal settlement infrastructure, they aren't speculating. They're signaling the kind of foundation required to scale tokenization across global markets. The real issue isn't whether tokenization is coming, it's whether XRP is positioned to act as that foundational rail, and what it means for any asset that becomes essential infrastructure in a multi-trillion-dollar system. By the end of this discussion, you'll see a connection that many crypto investors are overlooking. At the Anando Summit, Franklin Templeton executives didn't describe a universal liquidity layer as optional. They called it a necessity. They emphasized the need for a system that removes blockchain fragmentation, so value can move seamlessly across the on-chain economy while maintaining a consistent unit of account. Here's the key takeaway. They said this missing layer must exist before real-world assets and securities can fully migrate on-chain at scale. Think about that carefully. All the excitement around tokenization, equities, bonds, real estate, treasuries, depends on this liquidity infrastructure being in place first. The structure they outlined aligns closely with the XRP Ledger's original architecture, a cross-chain liquidity backbone capable of institutional-grade settlement. Ripple's ongoing work around interoperability and tokenized asset integration fits naturally into the requirements Wall Street is now describing. Many retail investors dismiss institutional discussions because they assume it doesn't impact price action. That's short-sighted. Major infrastructure adoption tends to move quietly for years, then accelerates rapidly once critical mass is reached.
Now consider the timeline. When asked whether we are still years away from meaningful tokenization of transactions, one executive responded clearly. The destination is a world where most assets settle digitally, including real-world instruments. More specifically, he pointed to 2026 as the year this shift begins operating at scale. Not decades away, not theoretical, active deployment. He reinforced that his conviction hasn't weakened. He believes full digitized settlement across markets is inevitable. That language isn't casual speculation. It reflects strategies already underway.
This aligns with initiatives from NASDAQ, the New York Stock Exchange, and the DTCC. Each is advancing toward tokenized markets that operate 24 hours a day, 7 days a week. Today, U.S. markets function less than 1/5 of total time because of limited weekday trading windows. Imagine unlocking continuous global participation. Liquidity expands, transaction volume increases, capital flows accelerate across time zones. This transformation is not futuristic. The groundwork is actively being constructed. Another overlooked factor is access. Ripple recently appeared at the North American Finance Executive Summit alongside companies like Google, Amazon, Microsoft, IBM, Honeywell, NASA, Visa, and Capital One. These aren't niche blockchain gatherings. These are strategic infrastructure forums. Ripple's presence signals participation in shaping long-term financial architecture. Whether discussing frameworks in the US, the UK, or the European Union, Ripple consistently appears in regulatory conversations. Being present at the policy table matters. It influences how infrastructure standards are written. Now consider counterparty risk, a fundamental concern in traditional finance. Frank Lalonde of the DTCC recently explained that blockchain enables simultaneous movement of securities and cash while significantly reducing counterparty exposure. In capital markets handling trillions, this is critical. Counterparty risk means the other side of a transaction might fail to meet its obligation. Banks can freeze accounts, issuers can default, brokers can restrict withdrawals. These risks are embedded in legacy systems. XRP differs structurally. Holding XRP means holding the asset itself, not a liability issued by a central party. There's no issuer who can default, no IOU embedded at the protocol level. Stablecoins, even fully collateralized ones, always depend on an issuer. XRP does not. For institutions transferring billions, that distinction is enormous. Real-world deployment is already happening. On February 20th, 2026, SBI Group in Japan confirmed production use of the XRP Ledger for payment settlement. This isn't a test environment. It's live infrastructure. SBI Ripple Asia formalized agreements to support blockchain integration across financial services, explicitly referencing the XRP Ledger's implementation by institutions globally. Liquidity is already flowing, the experimental stage is ending, but global payment systems remain fragmented. The US has FedNow, Brazil runs Pix, India uses UPI, Europe operates SEPA Instant, Canada relies on real-time rail. These systems were built domestically and don't naturally interconnect. How do you link them without forcing every nation to rebuild its infrastructure? This is where interoperability becomes central. The Interledger protocol was designed as a neutral layer that connects different payment networks across jurisdictions. When value needs to move between systems, liquidity can be routed through XRP as a bridge asset using the XRP Ledger for final settlement. XRP functions as a neutral intermediary, enabling rapid, deterministic settlement between currencies and rails. The protocol operates over the internet, meaning it can integrate with existing systems without requiring structural overhaul. Behind every simple payment lies complex routing, currency conversion, balance verification, and settlement coordination. A neutral bridge asset that minimizes counterparty exposure is what allows this architecture to scale globally. Now consider something subtle but revealing. In a recent interview, Brad Garlinghouse was asked whether Ripple might acquire a bank or instead continue partnering with banks. His response was notably cautious. He sidestepped part of the question, elaborated on partnerships and regulatory positioning, and then explicitly declined to address the possibility of purchasing a bank. That hesitation suggests strategic sensitivity. If Ripple were to integrate deeply with or acquire banking infrastructure, it would gain direct access to traditional rails while offering blockchain settlement capabilities in return. The boundary between conventional finance and digital assets would blur significantly. Combined with Ripple's conditional regulatory approvals and its rapidly growing stablecoin business, the broader strategy becomes clearer. Ripple may not only be building tools for banks, it could be positioning to operate within the banking ecosystem itself. David Schwartz has also described the XRP Ledger as a potential multi-chain trading hub. Asset portability is central to that vision. Features like the built-in DEX, payment engine, and pathfinding enable movement of assets across blockchains. In the early days, one of the XRP Ledger's first use cases was facilitating faster, cheaper Bitcoin transfers. Bridges and issued assets allow tokens from different chains to be represented and traded on the XRP Ledger. This forms a foundation for a multi-chain financial environment. Schwartz emphasized that mass adoption requires seamless user experience, which in turn requires solving interoperability challenges. The XRP Ledger could function as a foundational bridge component in that architecture. Now connect everything. Franklin Templeton calling for a universal liquidity layer. Institutional events hosted on infrastructure connected to XRP. SBI deploying XRP Ledger settlement in production. Ripple present in regulatory and market structure discussions. These are not isolated developments. They represent convergence. XRP was architected as a counterparty-free bridge asset capable of settling cross-border and cross-chain transactions within seconds. For years, that capability existed before traditional finance fully acknowledged the need. Now institutions are openly describing the requirement for neutral settlement layers and universal liquidity systems. When a multi-trillion-dollar tokenized market begins aligning around infrastructure characteristics identical to what XRP provides, the implications become significant. Regulatory clarity is improving. Institutional integration is accelerating. Production use cases are live. The alignment between XRP's design and the direction of global finance is no longer abstract. It is unfolding in real time. The next stage depends on how quickly infrastructure adoption scales and how deeply integration penetrates traditional systems. The pieces are aligning. The question is how the market will respond as this convergence continues to take shape.